Next thing is refunds of overpaid VAT. Give me 1 second. Refunds of overpaid VAT. Yep, there are 4 years time on right to reclaim overpaid VAT. So if you have overpaid your value-added tax, you have got 4 years until you can claim your overpaid value-added tax. Next is a tax point. Now it is important for a theoretical point of view of ACCA F6 taxation, especially in MCQ's question. Now, what is a tax point? Tax point is when the goods are sold or invoice is issued or payment is made. It is called tax point. It depends on different circumstances. So let's read the notes. The tax point of each supply is deemed date of supply. The tax point determines the VAT period in which the output tax must be accounted for and credit for input tax will be allowed. The basic tax point is date on which the goods are removed or made available to the customer. Now that is normal, that is a normal tax point or basic tax point. What's that? Whenever the goods are delivered to the customer or goods are removed from the warehouse. Whenever the goods are removed or made available to the customers. Then it says if VAT invoice is issued or payment is received before the basic tax point, then the advance date will become the tax point. Then this date will become the tax point. So if the VAT is issued or payment is received before the basic tax point, then this will become the tax point. However, if the advance rule, the second rule, does not apply and VAT invoice is issued within 14 days after the basic tax point, then the invoice date becomes the tax point. Alright, so there are 3 different rules. So first, the normal rule is that whenever the goods are removed or available or made available to the customer, that will be our tax point. Now, if the invoice is issued earlier than that, that will be our tax point. However, if the invoice is not issued earlier than that, invoice is issued within the 14 days, then that rule will apply. So, which is the third rule. Right then, VAT records. Now this is information which you can find on the VAT invoice of the business, and it is very, very important for F6 again, because the examiner has examined in a couple of previous exam sittings as well that tell me that what information you can find on VAT invoice, right? So this is the information you will be able to find on standard VAT invoice, or examiner can give you a standard VAT invoice and examiner will ask you that tell me any mistakes in this VAT invoice, any additions need to be made, which information is omitted from this VAT invoice, then you will have to tell them. So what information can you find on VAT invoice? Supplier name, address and VAT number, name and address of the customer as well, tax point and invoice number, description of goods, type of supply and value tax rate, tax exclusive amount of each supply, amount of value tax, a rate of any cash or settlement discount if there is any. All VAT records must be kept for 6 years by your registered persons. That is also one of the important information. So if you are a registered value tax, you must keep your information for 6 years. You must keep your records for 6 years. Treatment of discount. So if you have given a discount to a customer and you said that I will give you this much discount if you paid me within 30 days, right? So if you have given any discount for prompt payment, earlier payment, then you will have to deduct that discount before applying the value tax. So that amount, then you will deduct the discount out of that. That is the net amount on which you will have to charge the value tax. So after discount price. If the discount is offered for prompt payment, then the value tax is accounted for on the price after the discount if the discount is actually taken by the customer. Relief for bad debts. Now under cash accounting scheme, as I said earlier as well, you will get automatic bad debt relief. But if you are not joining, if you do not have any cash accounting scheme, then what would happen? Normally VAT output is accounted for when the VAT is issued. So as I said, when VAT is issued, you will have to account for value tax, and then you will have to pay in the next VAT return. You will have to pay the value tax liability in the next VAT return. If the sale becomes a bad debt, the seller has paid VAT to HMRC. So if the purchaser did not pay us and we have paid the value tax to the HMRC, then to HMRC, and never recovers this from the customer, then this position is addressed by the seller being able to claim VAT, value tax, bad debts relief, provided that at least 6 months has been elapsed. As I said to you earlier as well, while looking at the cash accounting scheme, you must wait for 6 months. If it has been 6 months, then you can recover. And you have written off in your accounts, and you have written off the amount. The debt has been written off in the seller's book. Relief is obtained by adding VAT element in the output section. In the input section. Right. So what happens if you import something out of the European Union or outside of European Union, or if you export something to the European Union countries and outside the European Union countries? Now, as you might well be aware that the process has already started to leave the European Union for Britain, after the Brexit. So which means that Britain will be eventually leaving the European Union within 2 years' time from now. So which means that there will be different rules when Britain leaves the UK. But we are currently studying the current rules, which mean that we will assume that Britain is still within the European Union. So what the value tax rules are: whenever you sell anything to European Union countries, it is called dispatch. When you sell anything outside European Union countries, that is called export. Now, you might well be aware from your economic studies that exports, when you sell something out of your country, that is good for your country because it will bring some money into it, into our country. So be it export or dispatch, we both agree that it will be good for us, right? Now, if we acquire something, if we buy something from European Union countries, that is called acquisition for our value tax purposes. So we are buying something from European Union countries. Likewise, if we buy something out of European Union, that is called import. And we both agree that imports and acquisition are not good for us, not good for our country. So likewise, the government, UK government, thinks the same thing as well. They think that when you sell something out of your country, that is good. However, when you purchase something from other countries and you bring it to your own country, that is not good for us because you are paying for it. So then they will give you some relief if you sell something, and if you do not sell something, if you purchase something, you will have to pay extra penalty value tax. Right? So what are these? Let's see. Normally, VAT output. The term export. The term export refers to goods sold to the countries outside European Union. These are treated as zero-rated supplies. Now, as I said, government thinks that when you sell something, it is good for us, so it will be treated as zero-rated supply. You will be charging VAT at the rate of 0%. The term import refers to goods purchased with countries outside the European Union. These are treated as standard rated or zero rated, as it would have been taxed in the UK supplies. So if you are selling something out, if you're buying something out of the European Union countries, then it will be, VAT will be charged as either standard rate or zero rated, as it would have been charged within the UK. So government says that you will have to pay value tax. The term dispatch refers to goods sold to countries within the European Union, and they are again zero rated. So when you sell anything to European Union countries or outside European Union, it will be zero rated. When you buy something out of European Union, it will be standard rated or zero rated, as it would have been taxed within the UK. What if I purchase anything from the countries of European Union? If I say, for example, purchase anything from France, what would happen in that case? Now, because of the agreement between the European Union countries and Great Britain, because of the agreement between them countries, because European Union, Great Britain is still part of the European Union anyway, because of the agreement, they can't charge any value tax from the purchase and sale within the European Union. So when when I purchase anything from France while sitting in England, I will not have to account for any value tax. Likewise, if I sell anything, I won't charge any value tax. But because we have to comply for our local English British rule as well, so if I purchase anything out of the European Union countries like Italy or France, then what would happen is when the goods come to London, then I will charge value tax as I would have charged within the UK, be it standard rate or zero rate. However, the same amount will go into output tax as well. So the eventual effect is going to be zero, which means we are not only complying with the European Union rules by not charging any value tax, but we are also complying with the British rules, HMRC rules, by charging value tax in the input tax. Right? So if you're buying anything from France or Italy, from the countries within the European Union, the same amount will go into the output VAT and input VAT, so that we are complying with both rules. Right? So as it says in the notes, the term dispatch refers to the goods sold to the European Union countries. They are treated as zero rated. The term acquisition refers to goods purchased from countries within the European Union. They are taxed as both output tax and input tax at standard rate or zero rate, as it would have been taxed in the UK. Same amount will be written in both output VAT and input VAT, so the net effect is going to be neutral. Right? So let's move forward. On page 66 it says deduction of input VAT. For input tax to be deducted, the person must be registered and must hold VAT invoices of the supplier made to him. Of the supplies made to him. The distinction between capital and revenue does not apply for value tax purposes, and VAT registered person can claim all the input tax on supplies to him in the course of the business, so all of the value tax can be deducted. However, there are certain things on which you cannot deduct value tax. Non-deductible input VAT. The following input VAT is not deductible. VAT incurred on purchase of motor cars not wholly for business purposes is not deductible. So if you have purchased any motor car that is not for business purposes wholly, VAT on that is not recoverable. If car is used wholly for business purposes, the input VAT is recoverable. However, the VAT incurred on repair and maintenance of the car is wholly deductible, and no apportionment for private use is required. So if the car is used for private use and you have done any repair or maintenance, then the whole amount is recoverable. VAT incurred on fuel for business purposes is deductible as input tax, but if the fuel is supplied by the business, if the fuel is supplied by business for an individual's private use, then the business may claim input tax but must account for output tax according to scale chart given in the exam question. Right? So if you have done any repair and maintenance, you will have to charge. You can claim the whole amount for value tax purposes, and for fuel as well. If it is for business purposes, and if any scale charge is given to you in the exam question, you will have to account for like that, like we have seen in our income tax. Right? Now, VAT incurred on business entertainment for UK customers, it is not deductible, and VAT on non-business items as well, it is not deductible too. Right? So then it says pre-registration input VAT. Now normally VAT incurred before registration cannot be accounted for as input VAT. If the conditions below satisfied, then it can be treated as input VAT. So if you have got registered now for value tax purposes and you have been incurring some expenses before registration, them expenses can be recovered. If the conditions below are satisfied, so first for goods, it says goods must be acquired for business purposes and should not be sold or consumed prior to registration and should still be in the stock. Right? So if you have any goods in the stock, you can recover value tax on that. However, it must be acquired for business purposes and should not be sold. Then it says goods have been acquired for not more than 4 years prior to registration. So if you have purchased any goods for more than 4 years ago, then you won't be able to recover any value tax on that. For services, this limit is not 4 years, it is 6 months. So the services must be supplied for business purposes. The services should not have been supplied for more than 6 months prior to registration. Right? Now on next page it tells us some penalties if you are late for submission of the VAT return or you are late for paying the VAT liability. Then what are the penalties? Default surcharge. A taxable person submits if a taxable person submits a VAT return late or submits a return on time but the payment is late, then a default has occurred. Now default means that HMRC will give you a warning. HMRC will send you a notice of warning. That is called default. The HMRC will issue a surcharge liability notice. Now this notice is surcharge liability notice, which I said a warning, which would specify the surcharge period. Now HMRC will say this is a surcharge liability notice which you have got by post. Now in that surcharge liability notice, HMRC will say that please make sure you pay every return on time for 1 year period. Now if within that period, if you pay any VAT liability late again or submitted the VAT return late, then you will have to pay penalties. So which would specify the surcharge period, which lasts for 12 months normally. If within this period taxable person concerned makes a further default, a default surcharge is also levied, which is calculated as percentage of the tax paid late. Now this table will not be given to you in the exam, so you will have to learn this. A default involving late payment of value tax in surcharge period. So if it is first default, you will have to pay 2% penalty. If it is second default, you will have to pay 5%, and it can go up to 15%. Now 15%, 2% and 5%, 10% of what? Surcharge as a percentage of value tax outstanding at the due date. So whatever the value tax is outstanding at the due date, this percentage will apply to that amount. Penalties on errors shall be same as for income tax, as we have seen earlier. And interest on unpaid VAT, interest is charged on VAT paid after the due date, and you know that interest charge rate is at the rate of 3%. Official rate of interest is 3%, so we'll charge VAT at the rate of, we'll charge the penalty at the rate of 3% if we have underpaid. Right? So that's it for this video, and I will see you in the next video, and we will do a question on value tax. Right? Thank you very much and goodbye.